Hello everyone, welcome to StudyIQ. So we will continue our discussion on economy. In this session we are going to talk about monetary policy. Okay, so in the last session, if you go for a quick recap, we have discussed about money supply and we have discussed about the concepts of money supply. We have understood what is M1, M2, M3, M4 and the reserve money M0 also we have discussed. Okay, so M0 we have discussed, and then we have discussed the concept of money multiplier, and then we have understood money supply as equal to money multiplier into M0. So this is what we have done so far. What is M1? M1 is nothing but the currency plus the demand deposit plus other deposits. Okay, so if you have missed out this video, you just go and watch that video first and then come to this. Okay, you can get that videos in this Telegram channel, or you can join this this Telegram channel. You'll get all the videos, or this is my Instagram ID. You can get in touch with me. So M2, what is M2? In M2, M1, this entire portion will come plus savings deposits in the post office. Okay, savings portion of the post office, savings account with post offices. M3, what all things will come? Entire M1 will come, the same 3 will come, plus the time deposits will come. Okay, so M1 plus time deposit. Then M4, entire M3 will come plus the entire post office accounts will come, PO accounts. Okay, so M1 is known as narrow money, narrow concept, 100% liquid. M3 is known as broad money. Okay, M3 is a broad concept. Time deposit is also included, so it is known as broad money. M0, currency plus reserve plus other deposits. Reserve means cash reserve ratio, etc., which is there with RBI. M is the money multiplier. Okay, so this is where we stopped, and we have discussed about the functions of RBI. Okay, now then I told you RBI is actually controlling money supply. How RBI will control money supply? Money supply means it actually shows the purchasing power in an economy, right? So if money supply is increasing, what does that mean? Purchasing power in the economy is actually increasing. Purchasing power is increasing means automatically the demand in the economy will increase. Demand in the economy increase means there are two outcomes here. Either the growth will increase automatically, inflation will also be there. So inflation is not considered desirable, growth is considered desirable. So this is a dilemma now. Okay, so if you do something to tackle inflation, it is directly going to affect the growth also. So how to reduce inflation? If you need to reduce inflation, you have to decrease demand. If you decrease demand, growth will be affected. So you want to decrease demand. Okay, so decrease demand means inflation can be controlled, but growth will be affected. Not desirable from growth side, desirable from inflation side. How to control demand? Purchasing power should come down. That is not desirable from the side of growth. If the purchasing power come down, money supply will come down. So if money supply is coming down, inflation will come down. Inflation will be reduced. At the same time, growth also will be compromised. Okay, so both will go hand in hand. So if you need to achieve inflation, you have to compromise growth. If you need to go for growth, you have to compromise with inflation. So this is a dilemma that RBI face, and this is the monetary policy dilemma. Now there is another concept, monetary policy trilemma. We will discuss that also after some time. Okay, so here what we are going to discuss today, today's session is all about this monetary system or the monetary policy. Okay, monetary system we have already done. Monetary policy, you will definitely get 1 or 2 questions from here for sure. Okay, so firstly let me tell you what is monetary policy. It is a component of economic policy. It is the component of economic policy through which central bank regulates money supply in the economy. Now how central bank is going to regulate money supply? I'll tell you that measures. There are contractionary measures, there are expansionary measures, CRR, SLR, bank rate, okay, reverse repo rate, marginal standing facility, okay, open market operation, all these things are there. We will be discussing all about this, and we will also talk about qualitative measures also. So today I'll start with quantitative measures. I'll complete that tomorrow, and we'll also discuss about qualitative measures later. So that's about that's how it's a component of economic. Economic policy is broader. It is a part of economic policy through which central bank regulates money supply in the economy. So what is monetary policy? It is a policy through which central bank uses its different methods like SLR, CRR, the tools or RBI, which is there with RBI. RBI use it effectively to increase or decrease money supply. So it is a policy through which central bank uses instruments under its control, means CRR, SLR, repo, reverse repo, etc. Instruments under its control to regulate availability, cost, and end use of the credit, and currency in the economy. Okay, so what do you mean by this cost? How to regulate cost? The increasing and decreasing interest rate is actually the cost. Okay, so currency in an economy, if you need to get money, there is a cost for money. What is that cost? It is the interest. So cost and end use of credit, that is the final purpose, okay, final use. Now let's quickly look into the objectives of monetary policy. Objectives of monetary policy. So first and most important one, as we have already discussed, inflation control or price stability. Price stability or inflation control. Okay, and it is also equally important to promote growth, because RBI have to take part in the developmental role also. So to stimulate economic growth. Stimulate economic growth. Okay, third one, stabilization of exchange rate. Stabilization of exchange rate. Now how exchange rate can be stabilized? By adjusting the money supply. See, if there is more money supply, what will happen? Demand for dollar will be more, right? So this is the quantity of dollar demanded or supplied, and this is the price of dollar in terms of rupee. Let's suppose this is a situation, current situation, and this is the equilibrium point. Okay, now if money supply is increasing, means what? People have more money, people demand dollar, so demand for dollar increase. What will happen? You can see here, price of dollar will increase in terms of rupee. So 67 to 74. This is known as depreciation. So money supply is there, means that lead to depreciation. If money supply is less, means, do you think this will happen? Now instead of increasing demand, there will be a decrease in demand. Okay, so there is a possibility that rupee may appreciate. So like this, you can adjust money supply to adjust the exchange rate also. Not only by interfering in the forex market, RBI can control the exchange rate. RBI can control the exchange rate by adjusting money supply also. Okay, so fourth one, strengthening financial system. Normal. Strengthening financial system, and then employment generation, and all this you can write. Poverty alleviation, all this can be written, because it is all dealing with interest rates. So anything now connected with growth you can actually write here. Okay, so the fundamental 2-3 objective is what I want to tell here. These three is what most important, out of which the first two is most important one. But the problem is, if you, as I have discussed already, if you try to achieve the first one, if you try to control inflation, you have to go for contractionary policy. I'll tell you what is this. And you have to increase the interest rates, so it will drastically definitely affect the growth. And if you try to promote growth, you have to reduce the interest rate, so money supply will be there in maximum, so you have to compromise on inflation. More inflation will be there, so both cannot be achieved together, both going hand in hand. Okay, so now here I'll show you in that diagram here. So we will go for, see, when we discussed in microeconomics concept demand supply chapter, when we discussed, we have talked about quantity in the x-axis and price in the y-axis. Now we are going to talk about macroeconomy. So in macroeconomics, in the x-axis we'll go for national income or national expenditure. This has to be kept in mind. So x-axis will go for national income. Y-axis, we won't go just for price, we will go for average prices, okay, or we call it as price level. So price level is nothing but average price. So let's say this is the current situation, and we will go for, instead of supply, aggregate supply. Instead of demand, we will go for aggregate demand. So this is the basic that you need to know in case of macroeconomics. In case of microeconomics, normal quantity of quantity demanded, the price, okay. So let's suppose this is the quantity demanded and supplied. So quantity is what you'll write here. Here you'll just write the price, okay. So it may be related to banana, apple. We have discussed all these examples. Now here, how this two go hand in hand? You can see here from this. Let's suppose if money supply is increasing, what will happen? Demand will increase. What will happen with the aggregate demand then? It will increase. So demand curve shift rightward. So shifting rightward. Now you can see here, this was the previous position. There's an equilibrium position. So now there is a rightward shift. What that result into? Rightward shift result into increase in price. But at the same time, you can see the positive here. There is an increase in national income. You see increase in national income. Okay. So what you can conclude here? Inflation is there, but national income is also increased. That means growth is there. On the other hand, if you try to, suck out money supply, that means reduce money supply, it will reduce the purchasing power, the demand will reduce, aggregate demand will reduce. So let me shift that curve to leftward or downward. Okay, leftward is better to say. So now the new position is this. You can see here inflation, the prices come down, but you see here growth is compromised. Okay, so it is affecting the growth. So what I want to tell you here is both can be achieved simultaneously. You have to compromise one for the other. So what RBI will do is RBI use a balanced approach between the two. RBI have to go for balanced approach because RBI have to control inflation at the same time. RBI have to promote the developmental efforts, and development also has to be promoted. That is also one of the most important function of RBI. But in 2014 there was a committee, Urjit Patel committee, and Urjit Patel committee actually recommended that RBI should go for or adopt inflation targeting, and from there onwards the most important focus of RBI is actually control the prices. Okay, even if it is compromising the growth, you have to control the prices. So inflation targeting or controlling inflation is the most important function, priority, if it comes between growth and development. And because of that, RBI and government is in tussle, problems are there, because if you need to control inflation, interest rates kept on, you need to keep on increasing interest rate if you cannot tackle inflation. And that you can see 2013, 14, 15 times all this interest rates are increasing continuously so many times. Now that situation is not there because inflation has come down. Okay, now let's quickly see the monetary policy instruments. You'll get questions from here. Monetary policy measures or instruments. Okay, it is also called as credit control measures. Credit control measures. See, actually we are going to talk about CRR, SLR, bank rate, repo, reverse repo. All this is what we are going to discuss. There are two types, quantitative and qualitative. So quantitative or general measures. Okay, what are they? These are, first I'll write down and then I'll explain everything. These measures seek to regulate overall volume of money supply in the economy. That means it is actually used to increase or decrease money supply. This quantitative measures, okay, increase or decrease money supply, increase or decrease money supply. Thus instruments like CRR, SLR, all these are part of this. So what about the next one? Qualitative or selective measures. Qualitative or selective measures. So such measures are used to transfer funds from one sector to another. So that is, they actually affect money supply in specific sectors. It is not increasing or decreasing money supply in general or in the overall market. It may shift money supply from one sector to the other sector. Okay, so overall money supply remain the same. Like here you will be giving more loan to some particular sector, so you can increase the money supply in that particular sector. So that is what qualitative measures. Selective, why it is known as selective measures? Because specific sectors are selected. Okay, so we will be discussing shortly what is qualitative measures, what are quantitative measures. So we'll start with quantitative measures. So first we'll start with quantitative measures. Okay, so first one is cash reserve ratio. So what is cash reserve ratio or CRR? See, this is a percentage of the total NDTL, net demand time liability of the bank. You know what is NDTL? That has to be kept with RBI in the form of cash. So it has to be kept it in the form of cash with RBI certain percentage of NDTL. Okay, so it is the percentage of total deposits, I write it as NDTL, of banks to keep with RBI in terms of cash at any point of time. Okay, so those rates will vary, so I'm not talking about the rates because when I'm recording the video and when it is telecasted, I don't know, the rates may be different. Okay, so the CRR is like 4%, all this are there. So I'm talking about the current CRR now. That means if let's suppose 100 crore deposit is there, let's say 100 crore is the NDTL. If let's say 4% is the CRR, you have to keep 4 crore with the RBI. Okay, so usually no interest paid on such deposits may be paid. Earlier they used to pay interest, but negligible interest, usually no interest. Okay, now is there any limit to CRR? See, actually there was a limit in 1930. The RBI Act 1934, there was a limit, that is minimum 3% to maximum 15%. This limit was there, but now there is no limit. It was actually amended in 2006, and that means 0 to 100%. Anything RBI can ask to keep with the bank, even 100% also. See, you can see during demonetization time, huge deposits have come. So in fact, RBI actually used this tool. RBI actually asked the banks to keep the entire amount with the RBI. Okay, so there is no limit. What you need to know is there is no limit now because of this amendment. Okay, now what is the objective of CRR? It is firstly, you are keeping 4%. So in a way, you are protecting the interest of the depositors. So protecting the interest of depositors. Okay, and secondly, see, protecting 4% is not enough, whatever it is, but I'm just saying one point here. Most importantly, what we are discussing now, that is credit control. So credit control. Now I'll tell you how is that it actually going to happen with the same diagram that we have discussed here. You can see the diagram. Yeah, you see here we have used this diagram in all the sessions. So see, government, the currency is printed, let's say 100 rupee currency is printed, and government is buying something from A. Okay, A will keep deposit this money in SBI. Now SBI, what the SBI will do, 20%, or based on the statutory requirement, SBI will keep some money with them and lend balance amount completely, because the profitability will increase if your lending capacity increase. So if let's say CRR is 4%, that 4%, that means 4 rupee you have to keep with RBI. If CRR is 5%, you have to keep 5 rupee with RBI. So if CRR is actually increasing, what will happen? Let me show here. CRR increasing, what will happen? Credit creation capacity will decrease, right? Because banks have less money to lend now. More the money which banks can lend, more credit creation will be there. So here credit creation capacity will reduce. So effectively what will happen? Money supply will reduce. So money supply reduce means what will happen? Purchasing power will reduce. So purchasing power reduce means what will happen? Aggregate demand will reduce. Aggregate demand will reduce means there are two effects now. One, growth will be affected, but inflation can be controlled. So here, when you are increasing CRR, money supply decreased. So this is how it is actually going to happen. It is going to affect the demand, aggregate demand. If demand decreased, growth will be affected and inflation will also be controlled. So both cannot be achieved together. This is a monetary policy dilemma. Okay. So now secondly, CRR increase means another, when it comes to bank, another point you need to know is if CRR is increasing, how it will connect with the profitability of the bank. See, it is directly, keeping some more money with RBI idle. You are not getting any interest. So you are lending less money now. So profitability of bank will directly affect it. Okay. So profitability of bank will reduce. So this is what you need to know about CRR. There's a percentage of NDTL, the total deposits of the bank, which has to be kept with RBI in the form of cash. Okay. So it actually help in credit control. Now how it control the credit, I hope you understood clearly. Next we will move on to statutory liquidity ratio, SLR, statutory liquidity ratio. Okay. Now similar to CRR that we have discussed, this is also a percentage of NDTL that banks have to keep with themselves in the form of, it can be in the form of cash, it can be in the form of government security, it can be in the form of gold. Okay. So let me write down and then I'll explain this. Percentage of NDTL, that is total deposit, which banks have to maintain, not with RBI. In case of CRR you have to keep it with RBI. So here maintain with themselves in the form of specified liquid assets. Okay, so what are they? It can be cash, it can be government security, it can be gold. So I'm not talking about what is the current SLR. As I've told you, the session when I'm recording and when it is aired, the time will be entirely different. So that is up to you. You can, but that won't be asked in exam, whatever it is. So let me take, let's suppose it is 20%. Suppose it is 20%. We'll take in this way and we'll explain in that way. Now out of this three, in which way bank will keep? See, which will be giving more return for bank is what bank will use, right? Cash won't give any return. If you are keeping cash, it is just idle. Now gold will give you more return, but the problem is gold is not calculated on the basis of market price. The value of gold is actually adjusted on the basis of constant price, the previous year price. So gold also you won't get much return. So you prefer to keep this in terms of government security. So you get around 7%, 8% interest on this. Okay. So I hope you understood. Cash, there is no return. You have to keep it idle. Gold, if it is on the market price or the current price, it keeps on increasing, so the asset will increase. But that is not the case. It is actually measured in terms of a constant price. The reason is RBI is also controlling import of gold. Otherwise all the banks will keep it in terms of gold only, right? So not in terms of gold, GSEC. So there was actually one question before in prelims: which instrument of monetary policy is actually used by RBI to force the banks to buy government securities, or which instrument will help the government to get money from bank, or which instrument force the banks to lend to government? All these are same. Which instrument? SLR. Why? Because if you increase SLR, banks either have to keep it in these three forms: cash, gold or GSEC. They don't prefer cash or gold because they won't get any return. So if at all they need to get a return, they have to buy government security and they have to keep. And you have to maintain this. There is no other way. So you will buy that. When you are buying government security means you are lending it to government. So which instrument helps banks to lend or helps government to borrow money from the banks? It is SLR. Okay. Now, is there any limit to SLR? Just we have discussed in case of CRR. 1934 RBI Act, there was a limit, that is 25% was the minimum and 40% was the maximum. Now in 2006 it was amended 0 to 40. Okay, it will go from 0 to 40. Now, what is the objective? Objective, you can see it is kept with banks in most liquid form. So in case of exigencies, you don't want to compromise with the depositors. Okay, so to ensure adequate liquidity with banks so that they can meet withdrawal demands of depositors. And secondly, as I have told you, it actually compels the banks to buy the government bonds. Otherwise, bank won't buy government bonds because you hardly get 7% interest. You can lend that money and you can fetch more interest, right? So now you are compelled to buy. So you are compelled, at the same time you are getting interest, means there is no other option but to buy the government bonds or but to borrow, lend it to the government, okay? So third is most important. Here we need to discuss credit control. So as I have discussed before, like here, as in case of CRR, exactly the same thing will happen here also. Same thing will happen here also. Instead of, here we have discussed about CRR. If CRR is increasing, similar thing will happen with SLR increase also. So when SLR increasing, what will happen with the profitability of the bank? It will definitely reduce. Secondly, SLR increasing means you need to maintain more with banks, so you have less lending power. So SLR increasing, also same things will happen. SLR increasing, credit creation capacity will decrease, money supply will decrease, purchasing power will decrease, aggregate demand will decrease. It will affect the growth and it will control the inflation. So let me show you here. SLR increase, credit creation capacity decrease. So what will happen? Credit creation capacity decrease means money supply decrease. So purchasing power will decrease. So aggregate demand will decrease. So growth will have to be compromised, but you can achieve inflation. Okay, so this is how SLR can be used to control inflation. Now SLR decreasing means what? Credit creation capacity will be more because now banks have more money to lend, and money supply will increase, purchasing power increase, aggregate demand increase, growth will increase, but inflation will also be there. Okay. Now which one affect the profitability of bank more, SLR or CRR? See, in case of CRR, you are keeping money with RBI idle, no interest, no return. But in case of SLR, the money which you are kept idle, but you are getting some interest. So compared to CRR, SLR won't affect much, but still SLR affect the profitability of bank, but CRR affect directly. The maximum impact will be by the CRR. Now when you talk about government security, why government security? Because government can borrow from government security. So this instrument actually forced the government to force the banks to lend to government. Otherwise, banks won't lend to government at this very cheap interest rate, right? Now, how interest rate is actually fixed? See, RBI. Now, what about RBI buying government security? RBI buying government securities means money supply will increase or decrease. RBI buying back. RBI buying means RBI pump money and buying government security. So money supply will increase in the market. RBI selling. So this is in case of buying GSEC. RBI selling, money supply decrease. RBI selling means money is taken from the public. So selling, money supply will decrease. Okay. Now how this government securities are sold? There will be auction process by RBI. Let's say this is GSEC, rupee 100, and let's say maturity period of 1 year. Okay. So there will be auction. So different banks, SBI, UTI, HDFC, Punjab National Bank, okay, ICICI, okay, all these banks will come. So SBI say 90 in the auction, 92, 91, 95, 93. So these are the different codes. So who will win? The person who's quoting the maximum. PNB will get this bond, right? Because RBI is getting more from PNB. So now what is the interest here? Interest is actually the difference between the price at which the bond, the GSEC was bought, and the face value. Face value is 100. After 1 year, you'll get 100, but you are paying 95. So this is actually the return. Individual can't buy, only financial institutions through financial markets. Individuals can buy some bonds from post office, not these bonds. So now see here, this was also a question. When the bond price is increasing, what does that mean? Demand for more bond is more. Then what does that mean? Return is less, right? See, more price for bonds, that means more demand for bond means more price for bond. So you can see here price of bond is high, so return is actually less, so interest will reduce. Bond demand is less. Obviously simple, demand is less means you are buying at a very low price, so you may get it for like 90. If these people are, let's say if this is 88, 87, 86, 85, this person is offering 90, so you'll get it. Demand is less in this context. Okay, so you can see here more interest, 10 rupee interest you'll get, whereas in the first case 5 rupee. So more demand for bond, more price for bond, and the interest will be less for the government security. But less demand for bond means your buying price of government security will be less, so the return will be more. So I hope this is clear for you. Next session we'll talk about bank rate and other things, other quantitative measures. If you have any doubt, you can get in touch with me here. This is my Instagram ID. Join the Telegram channel, you'll get all the videos over there. Okay, so see you guys.